Hey, in this video, I'm going to share with you four reasons why an IUL life insurance policy may be better than investing in the stock market. If this is your first time joining me, my name is Alex. I am a licensed insurance advisor and a financial planner, and I help people just like you create more wealth, create more freedom so you can live your best life and leave a legacy for your family. If that's something that interests you, please consider liking and subscribing to my channel. So today, guys, I'm really excited to share some information with you. I think it's going to really shed some light on some misconceptions that people have about life insurance. So many people think life insurance is only for someone dying, right, and leaving money to their kids or to their family. But in this video, I want to show you how you can use life insurance, particularly an index universal life insurance policy, how you can use it any number of ways that I'm going to show you that's probably better for you than investing your money in the stock market. So with that, let's go ahead and get started. So I have here what we call an illustration, okay? And this is what I share with my clients. And we put all of your information in the system, and it allows us to pull together some very interesting facts for you so you can see just how powerful life insurance is. So in this example, as you can see, excuse me, let me go back. Oh, okay. So, so in this example, as you can see, I have information put into the system, and this young lady, this client, okay, her name is Smart Young Lady, right? Smart Young Lady is she is actually 36 years old in this example. All right. So let me show you just how powerful index universal life insurance policy is as compared to actually investing in the stock market. So in this example, we see smart young lady who happens to be 36 years old in this example. Let me show you. We're going to assume that this smart young lady has said, hey, she said, I have $50 a week, $50 a week that I can set aside for life insurance, right? To protect my family and for me to build up some cash value, right? So that I can build up a nest egg. So in this example, we assume that she is going to be putting in $50 a week. Now that isn't how much the life insurance cost. This is just how much she is going to be contributing to her life insurance. Okay. So this is going to make more sense here in just a second. So as you can see in this example, in year one, she is 36 years old. She has agreed that she wants to pay $200 a month. So right here, as you can see, that'll be $2,400 a year that she is contributing to her life insurance. Okay. But then a portion of that is going to her cash value. This is her account. This is her money that's growing tax free. So she's agreeing to pay $2,400 a year, and as you can see in this example, $1,786 is what's being deposited to her cash value account. Okay, the difference between the $2,400 and the $1,786 is roughly about $600. $600 is actually going to pay for life insurance. Okay. So she's really paying about $50 a month for life insurance. And the other portion is going to an account, her account, her cash value account that's going to be growing tax free. Okay. So, reason number one of the reasons why life insurance may be better for you than investing your money in the stock market, immediately when she established her life insurance policy, by her putting $200 in a week, that's what she agreed. I mean, $200 a month, that's what she agreed to put in. She she immediately she immediately is now receiving $151 of death benefit. Okay, that $151, reason number one, she can use that if she gets sick, chronically hurt, injured, or chronically ill. Okay, if the worst happens and she passes away, her family would get $151 and $151,000. Okay. Now, if you were to put $2,400 into the stock market and you got sick, you would only be able to get back what is in the account after paying taxes on it. Okay, so she would only be able to get the $2,400 if it happened to grow, if it grew during that year's time, and if something happened to her, if it grew within that year's time, she would have to sell her stock. She would then have to pay taxes on it, and whatever is left is all that she or her family would be able to get if she passed away, or if she got sick or hurt and she needed money, all she would be able to get is whatever's in the account. All right. In this example, she would actually be able to get access to $151,000 of death benefit or net benefit. Okay, so that's reason number one. You immediately get protection for your family, and if you needed to access your money, if you got sick, hurt, or unable to work, you were able to access up to, in this case, $151,000. So that's the first reason why. Okay. Life insurance, IUL, is better than investing in the stock market. It's like you buying money, and you are immediately protecting your family and your assets in case the worst happens to you. So that's the first thing. Okay. The second thing is, as you can see here, she has agreed that she's going to be paying $2,400 a year. That is her contribution. That part of that money pays for life insurance. But as I said before, the other portion of that money goes to her accumulated cash value account, as you can see here. So let's say she got to age 50, and she decided that, hey, you know what? I want to be able to buy some rental property. I want to be able to buy my first home. I want to be able to buy my second home. I want to be able to buy a car for myself. I want to be able to send my child to college. I want to be able to pay a portion of her tuition. Guess what? In this column, in the accumulated value column, as you can see, at age 50, she would have $41,000 sitting in her account that she can access for any reason. It doesn't matter. She doesn't have to go through credit checks. She doesn't have to have excellent credit. She doesn't have to have any credit. She has $41,000 of money sitting in her account, and she can access that money, in this case, at any time for any reason. All right. So that is the second reason why. Okay, let's go on. As you can see, if, Lord forbid, if smart young lady passed away at age 50, as you can see here, her family would get $196,000. Earlier, it was $151,000, but now, as you can see, it's grown to $196,000. So that's the second reason why. Okay. She has money that she can access, some cash value here that she can access at any time for any reason. It doesn't matter. It's her money. All right. So that is the second reason. Okay. Now, something else about this, which is very interesting. Let's say, for instance, at age 50, she decided she has $41,000 sitting here, and she said, "Hey, I want to get $30,000." All right. So what we would say is, okay, you never make a withdrawal from your account. What you do is you access your money with a loan. That's how wealthy people have been doing this for ages. They let their account stay intact because the account is going to continue to accrue and get a return for you over time. So you don't want to disturb. It's like cracking your eggs. You want your nest egg. You want your money to stay in the nest so it can keep growing in value. And instead, you just take out a low interest loan on the money. All right. So in this case, she said, "Hey, I want to take out. I want $30,000." She has 41,000 in there, so she takes out a $30,000 loan. Her check will be there in a week. No questions asked. She doesn't have to run through credit checks. And guess what? Now the interest on that $30,000 is somewhere between 4 and 5%. But guess what? Because her money is still sitting in this account, that $41,000 is still going to be growing at 6.5 or 7%. So guess what? Her money is growing at 6.5 or 7%. That $30,000 is she's only paying 4 or 5% on that money. So guess what? She's actually making money between the two. You see what I'm saying? So that $41,000 is still growing at about 6.5%. She accessed $30,000, and all she has to pay is 4 or 5% interest on the $30,000. So that's one of the ways I call it. I call it having your cake and eating it too, where you can have your money stays intact, your $41,000 stays intact, and it continues to grow, and you can access $30,000 of it, right? And all you have to do is just pay it back with low interest. You can choose not to pay it back, but that's a whole nother subject. Let me tell you something. This thing is incredible. All right. Everyone should have an IUL life insurance policy, a part of their wealth building portfolio and strategy. So if you try to put $2,400 into the stock market, all right, up until age 50. Who knows what that would wind up being? But let me tell you, the difference is if you try to get access to your money in your stocks, you would have to sell it. You would have to sell your stocks, $30,000 of it, right? In this case, but then you would have to pay taxes on the $30,000. So if you wanted $30,000, you would have to sell roughly about what? About 36 or $37,000, pay taxes on it, and then the difference is what you would get. And so now what you have just done is you have reduced the amount of money in your stock account, in your stock portfolio that could be working for you. So you can see how this situation or this scenario is a better setup for you to access your money at any time for any reason. Okay. So let's go on. So that was reason number 2. Let's go on. Reason number 3. Reason number 3 is, let's say that this smart young lady has decided she's just going to use this IUL life insurance policy as a personal retirement account for herself. So in this example, as you can see, the money that she has been putting in, the $2,400 that she's been putting in, she's going to continue to contribute that all the way up until she reaches age 64. Age 64. All right. At age 65, she has decided that she is going to retire. So let's look at it. So let's say, for instance, at age 65, right? Okay, age 64, she's been contributing $2,400 a year all the way up until age 64, and now at age 65, she's gonna stop. All right. At this point, she has $132,000 sitting in her cash value account, as you can see here. And she also has a death benefit that she can access. If she passed away, it would pass away to her family. If she got chronically sick or chronically injured, she would be able to access this to pay for some of her some medical expenses. All right, $210,000. All right. But in this case, she's decided at age 65, she's going to turn on what's called lifetime benefits. That's the third reason why IUL life insurance policy may be better than the stock market. She decided at age 65, she is going to stop contributing to her life insurance policy. She is now going to turn on her lifetime benefits, lifetime income retirement benefits. And she is now going to receive $9,000 a year tax free. Tax free. All right. She's going to receive $9,000 tax free, and she's going to get this for the rest of her life, however long she lives. So in this example, we're going to assume that she retires at 65 and she lives to the ripe old age of 90 years old. Let's go all the way down. So at 90 years old, that $9,000 would still keep coming to her every single month. Now, let's look at it. If she retired at age 65 and she lived to be 90, that is 25 years, right? 65 to age 90 is 25 years. Now, if we take those 25 years and during those 25 years, she's going to get $9,024 a year tax free, right? That comes to $225,600. That's how much she would have gotten in terms of lifetime income from age 65 to age 90. And she would never have to pay taxes on that money. $225,000. You hear me? You hear me? Plus, at age 90, she would still, as you can see here, she would still have roughly, her family would still have roughly $32,000 that they can use to pay for her final expenses or pay for other stuff. Okay. So altogether, she would have received, let me do the math for you. So altogether, she would have received $257,000 over her lifetime. Let me tell you something. And all she did was contribute $200 a month from age 36 to 64. And then she stopped at age 65 and she turned on her lifetime benefits. And her family were able to receive $257,000 of money, of income, tax free. Okay. So you might be thinking, well, who knows? You know, let's look at what that would have looked like if she had taken that $200 and if she had invested that $200 in the stock market. So, without making this too complicated, these are the historical returns of the S&P 500 over the last 20 years from 2001 to 2021. As you can see here, you had some down years, you had some up years, okay? When you put all of those down years and up years and you put them together and you average them together, okay? On average, people be saying you can put your money in the stock market, you can get 9%, 10%, 12%. Listen, from 2001 to 2021 to date, okay? If you take the ups and the downs, the negatives and positives, if you take all of those things together, the stock market over the last 20 years has only given you 6.26%. If you take all the up years and you subtract all the down years, that's what the stock market, that's the return that people have gotten, okay, in the S&P 500 over the last 20 years, 6.2%. But keep in mind, if you have your money in a 401k, if you have it in an IRA, guess what? You got to pay taxes on that. So when you factor in the tax rate, on average, people are really only getting 4.3% return. But let me tell you something, ladies and gentlemen. When you put your money in an IUL, life insurance policy, you never have to worry about having negative years. You never have to worry about your money, your value going down. As I always say, it's Cardi B. Once your portfolio value is up and it's stuck. It never drops. It never comes down because your money is not invested directly into the stock market. So, when you take into account those returns, okay, as you can see here on the blue line represents the stock market, okay? This is the blue line, all right? But then the orange line, the blue line is all up and down. It's all up and down. But see, the orange line is nice and smooth. It's nice and steady because it never goes down. When you invest your money or put your money in an IUL life insurance policy, you're able to get stock market returns without investing your money in the stock market. So because you never have to worry about losses, the IUL actually will give you a 6.45% return. Okay, in this example, if you take the last 20 years, the stock market performance over the last 20 years, if you take out all the losses, okay, this is where you actually your account value doesn't drop, you just don't get a return for those years. So you see some zeros in there. But if the stock market is up, you'll get the stock market return. When it's negative, you get zero. So your value doesn't go down. So if you average all of those together, your stock market, your return in the IUL is actually 6.45%. And because it grows tax-free, it's the same. It's 6.45%. So, Alex, what are you saying? So right here, I got my little calculation. If you were to invest your money in the stock market, in this case, we said the smart young lady would be investing $200 a month. If she invested $200 a month, Excuse me. And she invested it for 29 years. You remember I said she was going to retire at age 65. So from 36 to 64 is 29 years. So we plug in that number. And then we put in the historical stock market returns. You remember 6.26%. Then her value of her investment over those 29 years would get up to $196,000. But guess what? She has to pay taxes on it. So now it's dropped down to $147,000, assuming that she has a 25% tax rate. All right. So 147,000 versus, let's go back, versus 139,000 with the IUL. Okay? So you actually have more money in the stock market, but guess what? If she retired with this $147,000, how long would it be before she runs out of money? You remember I said before, if she turned on her lifetime income at age 65, she's going to get $9,000 tax free each year. And if she lived to be 90, she would get $225,000 plus she would have $32,000 of death benefit that could pass on to her family so they can take care of her final expenses and other stuff. You remember I said that came up to 257,000. If you had invested your money in the stock market, the 147,000 is all you got. So if you're taking out that money to live on over the years, then once this 147 is gone, it's gone. Plus, keep in mind, again, you have to take out more money. You have to take out $11,000 or $12,000 each year in order for it to equal the $9,000 of tax-free money. All right. So in this case, this would only last for about 12 years. So if she retired at 65, she can make it to about 77, and then all her money is gone. But if you go back to the illustration here, she's going to get this $9,000 if she lived to be 120 years old. She would still get 100. She would still keep getting that $9,000 each month. So, as you can see, ladies and gentlemen, the IUL has some incredible benefits. Again, number 4, the 4 reasons why: you get instant protection for your family if you happen to pass away, but you also get protection for yourself if you get chronically sick or chronically injured. Okay? You can access your death benefit, accelerated your living benefits. You can access your living benefits if you get sick or injured, right? With the stock market, there's whatever you've accumulated is what you would have access to, less taxes. That's it. Okay, so that's number 1. Number 2, the IUL life insurance policy gives you the opportunity to accumulate cash value tax free, right? And you have access to your money at any time for any reason. Okay, and in that instance, you can get access to your money via a small low interest loan. If you leave your money intact, it's still going to continue to grow for you right? And you're still going to be able to get your tax-free returns on your entire nest egg, and all you have to do is just access your a little bit of your cash value via a loan. So that's number two. Number three, you can turn on lifetime income tax free that never runs out. And then number four, the fourth reason why you should really consider putting your money in an IUL life insurance policy is you never have to worry about losing money in the stock market. So, if you just, I would encourage you to really go back and look at this video, or I really, really encourage you to schedule a free consultation with me. Schedule a no risk wealth consultation with me. You can go to candidly.com, screenshot this, right? Candidly.com/Alex Allure. Schedule a free quote with me or a free consultation, and let me show you the power of the IUL life insurance policy and why it is so powerful and how it can protect you and your family, provide you lifetime income that never runs out, how you're able to grow your money tax free, how you're able to pass on um, um, a legacy for your family for the next generation. Let me tell you something. This thing is so powerful. It is amazing. So go to candidly.com/Alex Allure, screenshot this, schedule your free appointment with me, and let me show you how life insurance, this IUL life insurance policy, can enhance your wealth building and your financial freedom prospects going forward. All right. So take care. God bless. We will see you on the next episode. Take care.